In the summer of 1997, a 20-year-old with a computer science degree completed through correspondence landed in Tokyo. He didn't speak a word of Japanese, and he had no grasp of the local business culture. What he understood was code. The Tokyo Stock Exchange needed that code. He was hired by a subcontractor to help build the technical foundations of the market itself. His task was the development of a matching engine. When a buyer wants shares at a certain price and a seller wants to sell at that exact same price, the system must pair them within milliseconds. Precision is the only priority. A mistake in the matching engine undermines confidence in the entire market, transforming a simple software glitch into a systemic collapse of public trust. As a young programmer, he wanted to build systems that were fast, efficient, and elegant. But in Tokyo, he was met by a financial technology culture that was deeply conservative and suspicious of new ideas. He worked within a rigid set of boundaries: strict limits on daily stock movements, mandatory halts for rapid price swings, and exhaustive documentation for minor changes. To a hacker-minded outsider, these constraints looked like arbitrary bureaucracy designed to stifle innovation and protect a slow, outdated status quo. Implementing the happy path, the normal scenario where a buyer meets a seller, is a straightforward task. The real work happens at the edges. He had to account for the one-in-a-million scenarios: 2 orders arriving at the exact same millisecond, an order hitting the book at market close, or a mid-trade system crash. He spent months hunting these anomalies, writing tests to watch the system fail, patching and retesting until the code held firm. The stakes of this testing were made clear during an internal simulation. A bug caused the virtual market to behave incorrectly, triggering a week-long investigation where every line of code was reviewed and every technical assumption questioned. This exhaustive process revealed a fundamental truth: the difference between a reliable system and a dangerous one is how it handles the unusual. Eventually, his perspective shifted. He realized that the frustrating constraints of the Tokyo Stock Exchange were actually the accumulated wisdom of decades of market crashes. Each rule represented a lesson learned at great cost. Price limits existed because unchecked volatility destroyed wealth faster than it could be created. Trading halts existed to allow for human breath in a system where speed could amplify errors into catastrophes. These deliberate pauses and boundaries prevented a single technical failure from becoming a total economic collapse. This is the skeleton of finance, the underlying structure of rules and constraints that makes the visible surface of the market possible. In 2001, he left Tokyo for New York. He carried a new respect for the conservative engineers who prioritized stability over being pioneers. He left with 4 guiding principles: respect the rules, test every assumption, handle the edge cases, and never forget that behind every transaction is real money and real consequences. While he still wanted to move faster than traditional finance would allow, he understood that he needed their architectural blueprint for stability to support his future innovations. Years later, this mindset guided him into the cryptocurrency space and the eventual founding of Binance. He entered an environment mirroring the Wild West, a landscape with unwritten rules, where participants focused solely on moving fast and breaking things. While other developers raced to launch new features, he looked for the edge cases that were still being discovered in the code. He applied the same tedious rigor he learned in Tokyo, identifying where the system would fail before the market could find out. In a lawless frontier, speed provides the initial momentum, but survival depends on the strength of the skeleton built beneath it.